Hi guys, welcome back. This is gonna be the video summary of episode 13 of the ICT Mentorship 2022. Please, as always, refer to ICT original content. This is just a refresh if you have gone through the material and you would like just like some pointers to remind yourself of what ICT was talking about in this episode. So let's get started. In this episode, ICT talks about what we have seen in episode 12 and he applies it, so it's everything that we have seen there in action. Plus, he shows us intermediate term lows and how to apply everything that we have seen for intermediate term highs in action for intermediate term lows. So this is an episode where we see the market structure for precision technicians applied. At the beginning of the episode, ICT talks about our own trading accounts and what we should be aiming to consistently when we are trading with his techniques. He tells us that we should be aiming at making 20% consistently, so 20% on our account every single month. Remember guys, we always trade at our own risk and it's always better to start with a demo account. We need to have a plan and to follow it. And it can look very different from person to person. Indeed, we need to tailor the plan that we are making for our trading to our own character and to our own personalities. Okay, and now let's look at the Nasdaq Micro E-mini futures on a one-day time frame. We are now at the end of February and the price had quite big movements in the past few months. So ICT tells us that the price went actually below first and then above the sell side liquidity, which is the line that we see here with the arrow. And so what will happen next? ICT tells us that depends on where is the next draw on liquidity. And so guys, where is the next draw on liquidity? Can you see it here on this chart? You can pause it for a moment and check it out yourself. And when you're ready, let's go. So ICT tells us that the price could potentially trade into this candle here. Specifically, it could trade on the low or the open of that candle. That could be our next draw on liquidity. ICT tells us also that the price could reach out to this area here. That is indeed a small fair value gap. Keep in mind that the price could be attracted to that liquidity level or to the fair value gap and then resume and go lower. So we don't know. We are not assuming that the price will for sure go higher. We're just noticing that the price could be attracted to those levels. And so guys, if we don't know something and we are not 1000% sure, we have to embrace it and go and search for clues to understand better what the price could be doing next. ICT tells us here that he went to see what the other indexes were doing, so just to have an idea while always keeping an open mind. And I want to ask you guys, do you actually remember what we have seen in episode 7? Because in the episode 7 of the ICT Mentorship, we have seen that indexes usually move in tandem. The fact that we have to try to understand why, and when we do, that will give us a competitive advantage. And we have also seen that we do need to look at the general direction with which they are moving and at cracks in correlation, if there are any, and at their movement strength. Basically guys, ICT tells us that he wants to see what other indexes are doing and he went and checked the E-mini S&P and the E-mini Dow Jones. He said that they both went higher, with more strength in the movement than what we can see on the Nasdaq. So we could actually think and assume that the Nasdaq E-mini futures could be going higher. So let's go back to our Nasdaq Micro E-mini futures on the 1 hour time frame. Let's analyze these price movements together guys. The Micro E-mini Nasdaq futures give for every point of movement or every 4 ticks an equivalent of $2, so keep that in mind. It's indeed the Micro E-mini Nasdaq futures. This is the movement of the price that we see on the 1 hour time frame. But where is liquidity? ICT shows us that our buy-side liquidity is actually here on the red line. And now it's time to observe the price movements together. We can see here that the price had a run down and then followed with a run up. Then the price has retraced back a little bit. Notice here in the red area how the market taps back into that level. The market there indeed taps back into the imbalance very shortly and then it starts rallying up We remember from episode 12 that if the price move has been bullish, down close candles should not be violated because they're going to be acting as our support. So guys, let me show it to you again. If the price move has been bullish, as we have seen because the price was rallying up, down close candles should not be violated. So those two that you see here with the red arrow are two down close candles and they will act as our support. So we would expect price to not go below them until it is bullish, so until it is rallying up and going up, and until our idea is supported. But the opposite is also true. So if the price move has been bearish, up close candles should not be broken. And so those up close candles will act as our support. And you see two here highlighted with red arrows. You can see that that price movement is indeed bearish. And you can see here these two green candles highlighted with red arrows. So again, guys, we are looking at a bullish price movement, and so those down close candles should not be violated because they are going to be acting as our support. Now let's look more in depth into this area here, first the pink one and then also the yellow one. So let me zoom in. Here we can see the Nasdaq Micro E-mini futures on the 1 hour time frame with a zoom in on that movement. I covered the side in yellow so that we can focus on this one first. This bearish candle is important because with it the price taps back down into the fair value gap before starting to go higher. So if the price later on taps back into this candle, ICT will treat that as a bullish order block. Let me say it again. If the price later on taps back into this candle here, into this bearish candle, ICT will treat that as a bullish order block. This is going to be the level that we're going to keep our eyes on and that we're going to be looking at, and if the price taps back into it, we know that a bullish order block is coming. So let's go back to our big picture. And you see here that level with a green line. Let me just recap for us as I did previously. Buy side liquidity is slightly higher than where we are right now. The price went lower and then higher. We checked on the S&P E-mini and we saw that index was actually going higher. So we are expecting or thinking that the Nasdaq could follow as well. We're keeping our eyes on the bearish candle and using it as our level. And now, last but never least, we are always looking at the time of the day. Let's focus now on the lows. So here, highlighted in the yellow area, by looking at the lows, we can see that we have a low that has a lower low on the left and another lower low on its right. When that happens, we know that the lower low of the three of them, it's gonna be our intermediate term low, and the two lows on its side are gonna be two shorter term lows. And this indeed is a little bit of an ideal scenario because the intermediate term low is indeed the lower level and the two short term lows on its sides are a little bit higher than him. By looking again at the yellow area, we can see here a low circled in red. That low could actually be trading into an imbalance, which we are looking for. But to know it for sure, we need to go on a lower time frame. Just to remind you guys, this is our buy side liquidity. And here you see two equal highs on the same level. And retail traders will see it as resistance. So they will be expecting the price to actually go lower. So notice, the price hits that level, hits the buy side liquidity, and then it starts going lower. And this is where it actually crosses again our level, the level of the bearish candle, the green line that we were looking at. So I made it here a little bit more clear, I put it in red. When the price actually taps back into our price level, into our support, what happens is that it jumps back up. And this is where we should be entering the trade. Bullish, of course, expecting the price to go higher with that order block. For all of you already asking, guys, I know that there are going to be a ton of questions, so I just wanted to answer them right away. Please notice here that this first low, right after the intermediate term low that is circled in blue, we should actually not be considering it as triggering our order block, because it's actually on the wrong time of the day. So it happens at 6 in the morning New York local time, and what do we do at 6 in the morning New York local time? We do not trade, guys. It's not within the time that we are trading, so we let it go. As always, guys, time of the day is important, is one of the most important things, and we really need to keep that in mind. Now, guys, with that in mind, let's go into a lower time frame to actually check our potential entry and see if there is any imbalance there, and if our idea would be supported on a lower time frame. We indeed need to be much more precise when we are entering the trade, and so we need to do it on a lower time frame. Now, guys, we are on a 15 minutes time frame, always on the Nasdaq Micro E-mini futures. We see here our red line, which is our buy side liquidity, and our green line, which is our support. Here we can see that the big 1 hour bearish candle is actually composed of 2 bearish candles on the 15 minutes time frame. And the big question, guys, is, after this bearish candle, do we have a fair value gap? Do we have an imbalance that we can use to enter the trade? And the answer is yes, a big yes. We see here in green a fair value gap. This is how we determine with high probability that there is gonna be a bullish order block. It must have an imbalance coupled with the down close candle and the underlying narrative. So everything needs to be there, everything needs to be in place. Now, guys, this is funny because the initial move right after the price goes below our green line for the first time is technically the wrong move. It is what ICT calls a Judas swing. That's mainly because it happens at the wrong time of the day, right? We've seen it at 6 a.m. and we do not trade at 6 a.m. New York local time. And as always, remember to put your charts at that time. But instead, the second time the price touches our green line, everything we need to see is exactly there. The time of the day, the imbalance, the willingness to go higher, we are in the discount for that day, and so on and so forth, like the stars are aligning, guys. Let me go now on the 5 minutes time frame, and let's absorb even more precisely the price movements here. On the 5 minute time frame, the price hits the order block, hits the green line, and then it rallies. And after rallying up, what do we see right there? Right there, after the price has touched the green line and started rallying up, we see a fair value gap. So we see here another order block on a lower time frame and another fair value gap. How I see it, guys, is that the order blocks are actually nested on lower time frames, and there is where we can actually enter with even more precision and with even more confidence. And if we were so good and we actually entered here where there is the red arrow, so where the price tapped back into the fair value gap, where should we exit? Where should we take our profits? Wanting to be safe, wanting to be right, we would exit above our buy side liquidity level, or right at it. And so that would be a very nice take profit, guys. As soon as the price touches the fair value gap, that low becomes an intermediate term low. And this specific intermediate term low should not be taken out. If that happens, we're wrong and we're gonna be having a losing trade. That could happen, guys. That's normal. Just try to keep it in mind. That's our signal, that's our level that needs to be respected. If the price goes higher, down close candles should be our support. But if we observe the wall price movements from the intermediate term low going higher, we can see that there are more fair value gaps there. ICT tells us that he has actually entered where we see the first intermediate term low. When he saw the second fair value gap being tapped back to, he actually increased his position, and that's the same thing that he did with the third fair value gap. Again, he increased his position when the price tapped back into the last and third fair value gap. I want to show you quickly here ICT markups. He highlights the lower and the higher end of the fair value gaps. After that, ICT proceeds and shows us his live trading on TradingView account. You can check it out on episode 13 of the ICT Mentorship 2022 at circa minute 27 and 30. ICT tells us that we should not be over trading, There are always gonna be setups. Maybe we can be trading even just like once a week would be enough if we have done it properly. Last time, guys, in the summary of episode 12, I've shown you a little bit about intermediate term highs, of which ICT has talked about a lot in that episode, and I also presented you a couple, actually 3, of the scenarios that I've been able to summarize. So in episode 12 we have seen this. We have seen intermediate term highs, the ideal scenario, the disrespectful scenario, and the weak market scenario. In this episode, ICT shows us intermediate term lows, and he shows us an ideal scenario, something that I have called the disrespectful scenario, and also the weak market scenario. And as always, guys, forgive my drawing, it's just like really to give us an idea of the concepts that he's teaching. Guys, keep going, do not give up, this is the way. I hope that the summary of this episode is useful for you, and feel free to use the links below to get all the free material. Wealth consists not in having great possessions, but in having few wants.